Welcome to the Remarkable Retail Podcast, episode number 304, the only podcast hosted by two of NRF's top global retail voices. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, we truly hope that you, our loyal listeners, were able to somehow backfill that hole in your week, not having a Tuesday episode of the podcast to listen to. Steve is back, and we're back on the mic to bring peace and order to your week. We'll be walking through the earnings season's wrap-up like a Sergio Leone spaghetti Western movie, comments on the stampede to value, Steve's observations from a merchant's perspective of Portuguese, Spanish retail, update on one of Steve's predictions, and a whole lot more. And then, of course, we'll wrap up with what is on our respective radar screen. So buckle up, everybody. It's a retail content bonanza. Steve, your pictures from the vacation were just awesome. I did hear that those European folks aren't so good at dealing with the Texas-style heat, though.
No, it was quite toasty for a good time, or a good chunk of the time that I was over there. So that wasn't so fun. But yeah, if you live in Texas, you're pretty used to this. But I was kind of hoping to escape the heat. So, but I made up for it by eating pinchos and tapas and so forth. So
nice.
It's all good, all worked out.
Well, we're going to get to your observations. You're never not a retailer, I suppose, as you're wandering around. So you got some observations for us a little bit later in the show. I had a great week. I closed the conference, the big store, Retail Council of Canada store conference, which you've been a keynote at in past iterations. I had a great panel with a diverse set of retailers that I somehow stitched together. Fourth generation president of Brown Shoes, a specialty shoe retailer, about 70 stores. President of IKEA Canada, and the CEO of the Jilly Box. And the Jilly Box is interesting because they send out a mystery box with Jillian, who's a big influencer. She has a lot of followers, kind of thing. And it's wildly successful. Like, there's years waiting list. They send out 20,000 of them every quarter. And now the task is to build, with Julia, their new CEO, is to build a marketplace that kind of extends it. Because how do you grow? The essence of the thing is so interesting because they have small vendors in it. And once you get past 20,000 units, you're not a small vendor, right? You're now into big scale. And last but not least, there's some galas in the evening, and a former guest of ours says hello, Kara Keating from PepsiCo.
Oh, yeah?
We talked to Kara. Yeah, she remembered our interview in that crazy interview in that small booth we had at NACS in Las Vegas. She's now the CEO of PepsiCo Canada, and she was awarded a Lifetime Achievement Award.
She got the Remarkable Retail Podcast bump as well.
She did. Without further ado, and there's been much ado, let's get into the news of the week. And I was kidding about a Sergio Leone Western movie, The Good, the Bad, and the Ugly. We can now whistle.
Yeah, I was going to do that, then I realized I was going to fail miserably. So know your limitations, kids.
We're going to get news of the week. And by the way, next episode, we've got another edition of our analysts episode coming up where we're going to go do some deep diving into some issues. But right now, we want to start with the good, the bad, and the ugly in the state of department store turnarounds.
Yeah, even before I get to that, just a kind of overall comment about earnings. I mean, for the most part, it was a really good quarter for retail. Some exceptions, as we'll talk about. But really, and I guess it's not terribly surprising given what we knew about sales results that have come out monthly, you can kind of piece together that probably the quarter is going to be pretty good for these guys. But I would also say that one of the themes, and I'll just mention this now rather than go through it for each of the companies we're going to talk about, and we're not going to talk about all of them. So we'll try to keep the ones we think are most interesting, and then a few we will save for next week. But most of the folks that reported said they were assuming things were going to be less rosy as to go forward. But anyway, there's one notable exception that I'll talk about. But yeah, as far as the state of the department store turnaround, I'll say the good-ish, the bad, and the ugly. The good-ish would be Macy's Inc. Now, the real star of the show here, again, was Bloomingdale's with comps up over 10%. Very impressive. Now, it's pretty clear, and we'll come back on this as well, but they are clearly benefiting from some of the chaos, maybe a lot of the chaos at Saks Global and some of the markets that are being exited where Bloomingdale's does have stores. So they have been getting a bit of a tailwind there. But I do really believe that Bloomingdale's has been executing very well. They're a fairly small chain, I think 33 stores in total. And the store portfolio is good, both in terms of the quality of the physical real estate, where they're located, and having a kind of distinctive position above Macy's, but below Saks and Neiman. So kudos to them. Will be interesting to see. I try to do an analysis and roughly figure out where there was overlap with Saks and Neiman Marcus, and probably close to 75% of the Bloomingdale stores by volume would be overlap with the continuing stores from Saks Global. And obviously on an e-commerce basis, they would compete nationally. But going forward, we'll see to what degree the new and improved, I guess you could say, but definitely leaner Saks and Neiman's are able to claw back some market share now that they've got inventory flowing to the stores. As far as Macy's, we're going to save this deep dive discussion on the Macy's nameplate for our conversation with Neil Saunders next week on The Analyst. But I will say that Macy's showed positive comps, but they are still losing relative market share. And most of the profit improvement came from the credit card business. So, I would say progress there, but I'm still not terribly convinced that they're getting significant traction. Now, the bad would be our friend at Kohl's. Now, on the one, I'll do the, two-handed economist here. On the one hand, they had their best comp performance in over 4 years. On the other hand, comps were down 1.1%. So when you're down and that's your best comp performance, that's not tremendous. Again, their sales performance is much worse than the category average. We've talked about 4 or 5% in apparel and, the soft lines businesses. So they're losing share at a slightly slower rate. They lost money in the quarter. So I guess the charitable interpretation is they are making progress, kind of stabilizing the company, arguably, but definitely not improving their competitive performance in any significant way. Now, the ugly, and I could say, it's a little bit of spiking the football, but you may recall, some of our listeners may recall, when people were starting to say that the JCPenney turnaround was gaining some real traction, I called BS on that. Part of what I thought was happening was, and we talked about this with the softer side of Sears a million years ago, was the invitation was better than the party. Put a lot of marketing behind it, drove some incremental traffic, got a little bit of a hit, but really fundamentally the business hadn't changed very much. This was very much evidence. Now, I should say, or evident in what they just reported. Now, just for clarity, because Penny's is a private company, their quarter that they reported, so the Kohl's and the Macy's quarter was the period ending in April. The Penny's quarter is actually the holiday quarter, the period ending in January. So they're always 3 months behind. So they managed to lose money in the fourth quarter, which is pretty impressive. And not only did they lose money, their losses went up by 77%. Their comps were down 8%. I would have, I would have predicted they were going to be negative, but not that negative. So this is really not great, obviously, and they're losing a lot of their cash balances. Now, I will mention two things really quickly, which we touched on before, people might know, but Penny's has this unique ownership structure. First of all, they were saved from going out of business because they were acquired by Brookfield and Simon Properties, basically to keep hundreds of stores in these malls from being empty. Then they formed this Catalyst group, which owns some apparel brands. Those apparel brands are being sold into Penny's. So there's kind of a complicated ownership structure. The debt is held at the Catalyst level. They took it out of Penny's, so Penny's is technically debt-free. But really, this is a business that is weakening quite significantly. But because of their ownership structure, they're probably not going to get the harsh reckoning that any other independent company would have. I mean, at this point, most likely any other retailer, unless they're somehow able to pull a rabbit out of the hat over the next few quarters here, would be closing probably hundreds of stores, honestly. So we shall see what would happen. But anyway, it was not a great picture unless you were Bloomingdale's. Now, on the positive side, on turnarounds, mentioned a couple really quickly. Really impressive, Victoria's Secret. This was a turnaround that I think was being met with a lot of skepticism, but they had not only the fourth straight quarter of comp store sales increases, they had a 13% comp store improvement.
Huge.
Big profit improvement. raised their guidance. So I mentioned at the top, most companies were saying, we think things are going to slow down a little bit. They didn't necessarily change their guidance, but basically said our rate of sales is going to flatten out more. Not Victoria's Secret. The turnaround seems to be accelerating. And I was thinking, we talked about Abercrombie and Fitch quite a bit. That was a brand 5, 6, 7 years ago in a lot of trouble, really lost their way for, a bunch of reasons. I'm sure some people know, quite a bit of scandal. But under new leadership, they came in, really got focused on simplifying and focusing the product line, pulled back on just kind of tons of promotions, overlapping things that just kind of lost the price integrity, much more discipline in execution, tweaking the store portfolio, upgrading, presentation, all these kinds of things. And that really seems to be all working out really, really well for them. The other one I'll mention is Gap Inc. Now, it's a bit more complicated. The big problems at the Athleta division remain. Old Navy, which is a huge percent of their volume, is kind of stuck. I think they were up about 1%. But Gap brand had their 10th straight quarter of growth and a 10% comp. So that is a business where, that particular part of Gap Inc. seems to really be gaining some momentum. Now, their profits took a step back. Some of that is the mix because Athleta struggling, Old Navy sort of struggling, and tariff impact. So, they've got to really get the whole portfolio working better. But at least the Gap brand part of it really seems to have some momentum as well.
Moving on, so I'm off to Calgary, Alberta for the Great Calgary Stampede. Now, speaking of the Stampede, let's talk about a Stampede for value, or something you've called the Great Trade Down. I love that. It continues. Talk about just the phenomenal success of the off-price retailers.
I know we keep coming back to this. I just keep feeling like how high is up with these guys, and the answer seems to be pretty high. TJX, which is a massive business, up 6%. Ross Stores, which we don't talk about too much. I mean, they're smaller than TJX, but still one of the big off-price players, up 17%. Burlington, up 6%. So, I mean, these are all businesses that are well above the retail average. A lot of this is clearly being driven by economic pressures. And so you do have this trading down phenomenon, which is, I think a lot of that is coming from department stores and others. But, their customer base here, because I want to contrast it a little bit with the dollar stores, because you'd think the Stampede to Value would really help the dollar stores. But for the most part, the dollar stores were kind of very modest comps. And if you kind of disaggregate what's going on there, most of the increase is coming from average unit retails being higher. So this is where I think the inflation is working its way in. It's not coming from transactions and customer growth. But, dollar stores are really much more focused. Not that they don't have any higher end customers, but, that's really more the economically challenged. Whereas off price is that customer, but also people that just like a really good deal. So I think you're seeing more of the trade down phenomena working in off price, whereas dollar stores is really, being squeezed by the economic pressures. Now, one to kind of, sometimes, I mean, technically they're a dollar store. Some people kind of think of them as off price, but Five Below, we talked about them last quarter, a business that continues to grow really, really quickly. Their comps were up over 20%. They're opening lots of stores. So while they're smaller than TJX, Dollar General, they're closing in on them. Now, one of the things that drove the business is this squishy dumpling thing, which I didn't know what that was, but I was doing my research here, so there's a little bit of a fad thing that's going on there, which probably is going to peter out in the next quarter or two. So we might not quite see 20% comps. But if you look at the trajectory for the last couple of years of Five Below, really, really been strong. So I definitely think they're a brand to continue to watch.
Your comments on the segmentation around dollar stores really resonate with me because in talking with a lot of retailers at the store conference at the value end of the segment, they really have a customer base that is when they put extra money in the gas tank or where they've got to put more money on the plate, it comes out of shopping and it comes out of anything remotely discretionary. In fact, it's beyond coming out of discretionary. That segment's got nowhere to go. I mean, they just stop shopping. They just have no more money to spend. So you're right. I mean, the movement down kind of stops at a point at the dollar store, right? Because their customers are just really, really really challenged. Let's talk about Costco. So what I've been observing about Costco, and you made reference to it, what a business. And I like how now that they're starting to separate results, gas, no gas, because gas price, of course, have gone up, and it would be quite hard to understand the business. But they're doing just a fabulous job.
Well, just being back from Europe, when you say gas or no gas, I first thought you were talking about water, but no, this is actually petrol or fuel. Well, the fuel business has always been important to several retailers, Costco being one of them. So a couple things to talk about. One is just, again, it goes back to what I've been talking about a lot, this great concentration. Costco, the number 3 retailer, net sales up almost 12%. Earnings grew nicely. Their reported comp was 9.8%. Now, roughly a third of that comp, though, was, to your point, gasoline. So they are really benefiting, if you can think about it in this way, from what has been going on, the results or impact of the Iran war. As fuel prices go up, essentially Costco uses fuel as a loss leader, not a profit center. And, that has been an important mix for driving traffic, because it turns out when people go to fuel up, many of those customers, either go to fuel up and then go into Costco, or they were planning to go to Costco and then they end up buying their fuel. So this is important to not only driving the rest of their business, it's also important to where they make, in one way of looking at it, most of their money, which is membership, because you need to have a membership to get that low price fuel. So it's really interesting. And I guess I'll make a broader point about loss leaders. I remember years and years ago, the CFO at Neiman Marcus, a guy named Jim Skinner, he had been at Comp USA prior to going to Neiman Marcus. And one of the things he said to me when he decided he needed to get out of Comp USA, when we had sort of the same experience of going from the outhouse to the penthouse, leaving a brand that wasn't very sexy to go to Neiman Marcus. But he said, once you realize that other retailers have made your core product a loss leader, i.e. computers and office equipment, you don't have much of a business. And, that's really kind of the same thing in a way. I mean, there was private equity and other things that went on at Toys R Us. But when Walmart and Target started to use the toy business to drive traffic to their stores, the margins really came out of the toy business more broadly, at least the high volume ones. So anyway, so it's just really interesting. I think the Costco formula, we tend to think about it as the non-fuel part of it, but this is really kind of the whole gas crisis, fuel crisis. It's really shining a light on how this works. Well, now, if and when fuel prices start coming down again,
and then it'll be their chickens, because everybody goes to Costco for a roast chicken or a hot dog. And the price of chicken's up in North America like 26, 27%. So, okay, gas moderates. Now I go to chicken. And then chicken moderate and then come in for a hot dog. And, it's fascinating. The Costco business is just so interesting because there's not like a loyalty program per se, but you buy in such volume, you're pantry loading and you're loyal for 6 weeks of toilet paper. So it's just a fascinating business. I could talk about, Sam's is the same, Sam's does a great job as well. These format businesses are just so exciting to watch and interesting to talk about, right? All right. So you're back from Portugal and Spain, and your pictures on Instagram are just beautiful, but you're never not a retailer. And so while you're wandering around,
for better or worse,
talk about your reflections of on the retail space. I mean, when I go to Europe, my observation is, boy, there's a ton of just little specialty retailers. You don't see a lot of big chains. There's a few, a little more so in London. But talk about your observations. Well,
I had a few. I mean, one, when you talk about the, I was thinking about this in the context of when we've been talking about the difference between, kind of the fork in the road between errands and experiences, buying, shopping, that whole kind of thing. Yes, you have a lot of the European retailers that are much more reliant on this kind of shopkeeper orientation, the mom and pops that have been there for a while, real specialists, here's the horchata shop or here's the whatever. So of course you see a lot of that, and that's a different mix than you see in North America for the most part. So that's really fun. And I think, you just get a very different kind of, that's not the, I don't see those stores really being impacted by shopping agents, right? It's a different kind of a dynamic, or going to the local food markets. So yeah, it's just, I'm always reminded of that when I travel in other countries, particularly in Europe. The second thing I wanted to talk about just quickly, so longtime listeners, or at least recent listeners, will know that I had a debate with Ken Pilot at Shop Talk about the future of the department stores, and Ken attacked me, saying I didn't know anything about department stores outside of Europe, or outside of the United States, I should say. And it turns out that's not actually true. But I decided that because I had been challenged, I would go to one of the department stores that he mentioned, El Corte Inglés, large Spanish retail. I actually went to 4 of their stores because I guess I had that kind of time. But 1 in Bilbao, 2 in Valencia, and then one of their very large stores, the Plaza Catalunya in Barcelona. And I have been in El Corte Inglés stores multiple times over the years. But I decided to go with a little keener eye to see some of the differences between the way the European department store model is executed. And so I would say my observations carry over to Galerie Lafayette, Selfridges, et cetera. But it really is interesting. I guess a couple of things I found interesting, or I was reminded of. The competitive dynamics are really quite different, at least with these flagship stores, because, we're talking about very crowded old cities. And so if you're El Corte Inglés in Barcelona, you're not surrounded by a Walmart and a Target and a TJ. Like, you just don't have an Ulta, and you just don't have all these specialty or value formats. Not that they don't exist at all, but the degree of competition, at least in those major city centers, is not nearly there. Secondarily, for the most part, in most of Europe, you don't have the North American suburban sprawl. So a lot of their volume is tending to be concentrated in the more densely populated areas. So there is a measure of competitive insulation and cultural differences there in terms of shopping patterns. So even though some of the European department stores have been quite challenged and have been closing stores, they're not in the same place that the North American department stores are for the most part. And another reflection there was just how different the merchandise mix is. So our older listeners will remember that Sears, Penny's, Macy's, all these stores 40 years ago had appliances and electronics, and a lot of the things that now you go to a specialty category killer, or you go to Walmart or Target to buy, not Macy's and Dillard's and Hudson Bay. But I'm also just struck by how big these stores are. And I got to think the productivity at all 4 of the El Corte Inglés stores that I was in has got to be quite low, particularly in certain areas. I was mentioning to you off mic, the main Valencia store has a whole huge floor devoted to kids. Like, I've never seen so much kids product in any one place ever. It's like, 4 times the size of a Kids R Us, or any other, 10 times the size of the kids department out of Walmart. So how that would be productive, I can't understand. But, they own these
Was there
stores.
anybody in the store? Like were you there?
No, I was not there in a particularly busy time. So that may be a little bit unfair. But, the other thing too with these stores, which just changes the dynamics, is they have food. They have a supermarket. So, the frequency they get from that. Now, that's typically in the basement. So that doesn't mean they get up to the 4th floor where the men's department is, or the 5th floor where the kids department is, or the 6th floor where the sporting goods is, or the 7th floor where the furniture is. So anyway, it's just, it's just a different model. But I think they will, slowly have a lot of the pressures, and the productivity there isn't great. But, what do you do with all that space? It's not easy to downsize. That's an expensive date. I don't know, maybe they turn them into condominiums or something over time. But anyway, the last thing I was going to mention, I was in Porto, and there is a bookstore there called Livraria Yeo. I'm sure I'm butchering the pronunciation there, but this is sometimes known as the Harry Potter bookstore. So despite the fact that some people think the Harry Potter bookstore is in London, or it's the library at Trinity College in Dublin, it's actually modeled on this particular store. J.K. Rowling lived in Porto when she was beginning to write the Harry Potter books, so that's why it's modeled on. But there were 2 things I thought was really interesting in it. One is you have to reserve a time and pay to go in. So you really know you're a remarkable retailer when people are paying to go into your store. Now, what you pay for the ticket, you can apply to a purchase. But people queue up at 15-minute intervals to go into the store. So if you do not book your time online, you are not walking into that store. Maybe there's times of the year when you can just wander on in, but that was not true. I had to book several days in advance, and you better show up between 11 and 11:15 or wherever you're meant to be there. But it's just a really beautiful store, and I think it's just something about how you create this image of you got to check out this store, and that's not something again, an agent or just e-commerce is going to put you out of business. So you could argue it's a bit of a one-off. But I also think, creating that kind of human magic is part of what makes stores like this, whether you're talking about other shops like that are must-visit stores, or you're talking about a restaurant, or, standing in line for barbecue in Austin, Texas, or whatever it is. Yep. So it's just kind of fun to see how that operates in different parts of the world.
All right, let's wrap up the show with a couple of things, a little bit more news of the week. Now, you've got some observations around this, what we've all called this race to the doorstep. I was struck when I was in L.A. a couple of weeks ago by the number of robots on the street delivering in West Hollywood, and it just seems to be like they were everywhere. It's like they were just, the place was lousy with them, as we would say. But tie that into one of your predictions and how that all is coming together for you in your mind.
Yeah, I was thinking as we go maybe through the summer here, maybe we'll just kind of go back and do a little bit of an update on some of my predictions. In the past, we've done kind of a whole show about a mid-year review. I think that's probably overkill. But one of them is this idea that the race to the doorstep is going to continue to escalate. And it's really looking like I'm going to be right about this prediction. We've talked in the past about Amazon keeps expanding their cities for faster delivery into rural areas, adding more fresh groceries. Target's had a few announcements. I mean, they got a long way to go here, but they've been adding some food specialized distribution centers to try to allow for more same day, but in particular, narrower delivery windows. Walmart had quite a bit of news, I guess about a week or so ago. They are expanding their 30-minute or less delivery to 33 U.S. markets, covering 100,000 products. This now allows them to reach 60% of U.S. households in 30 minutes or less for over 100,000 items. Now, part of this, of course, is tied to the battle with Amazon, but also Walmart's e-commerce business has grown 26% year over year, and store fulfilled delivery grew about 45% year over year. And expedited deliveries, sorry for all these numbers here, but expedited deliveries were 33% of all the U.S. store fulfilled orders. So we're just seeing the range of products that are available for expedited delivery and the number of products you can get in 30 minutes or less from Walmart, from Amazon, from Target increasingly just keeps going up. Then you've also got drones and, robots and, other kinds of things that are going on. But I think, what Walmart is really doing is, I wouldn't say exactly replicating the Amazon flywheel, but coming closer because their membership, the Amazon or the Walmart Plus business Walmart is growing Plus, quite nicely. So there's really much more of a head-to-head thing going on. And of course, Walmart has their store to be able to do immediate gratification and get more products, instantaneously if you're willing, or more or less instantaneously if you're willing to go to the store. So watch this space. It keeps just keeps ratcheting up.
All right, so last week we had breaking news from the Saks Global business. Well, it's not exactly breaking news. In fact, it's very predictable news, so I guess it's not breaking news. Anyway, they've exited bankruptcy.
Yeah, just to kind of close the loop a little bit here, because we have talked about this a bunch, and it did seem like the exit was imminent. So they did on Friday afternoon get approval from the Houston bankruptcy judge to exit Chapter 11. I guess just, and this is a little bit of a recap because we thought this was what was going to happen, but what got fixed, I guess, by virtue of their trip through bankruptcy is they cut their store base significantly. The balance sheet, which was really the thing that got them into Chapter 11, because they just took on way too much debt for the business as part of the Saks acquisition of Neiman Marcus. that self-inflicted wound of $2.7 billion in extra debt is basically gone. So they come out with still $1 billion plus of debt, but much more manageable. The equity holders got wiped out. So the senior lenders are now in the driver's seat. So leaner, meaner, much more workable balance sheet is, which is also allowing them to get more product in the store. So see above with some of what Bloomingdale's has been able to take advantage of. So this really, as this is also one of my predictions, was that they were going to get out of bankruptcy and they would be leaner and meaner and have a chance to be a viable, profitable business, at least in the short term. What doesn't get fixed is the competitive issues that got them in trouble over the last 10 or 15 years anyway, which is less about Bloomingdale's and Nordstrom's, though they are significant competitors. It's more about the competition from vendors and e-commerce only players. So that does not go away just because they're out of bankruptcy. So it remains to be seen whether this is a business. I've been saying I think they are a viable entity going forward. Whether they are a growth business, highly skeptical of, and whether they will generate the cash flow to update their stores and make the technology investment, I am also skeptical of that. But that is an issue that presumably will be a 2, 3, 4 year down the road issue. But it'll be interesting to see how this plays out and whether or not Bloomingdale's and Nordstrom's can maintain the market share that they were able to pick up while Saks went through its debacle of the past, whatever it is now, year and a half.
And I guess part of the last announcements was the final decision around the downtown Neiman Marcus store. I mean, it's in one way a local store, Dallas local thing, but it's got a lot of impact. We've talked about it on this show a couple of times. A beautiful store, and it's really a very meaningful exit from the core market, right? The home market.
Well, it's not really. No, it's not. I would say it's not a meaningful exit from Dallas. It's much more of a sentimental thing.
Emotional. Maybe I should have said an emotional.
It's emotional. Now, the down. I mean, I'm not going to. I know some of the numbers or have a pretty good idea with some of the numbers, but the downtown store. I'll just say real quickly. It's sentimental for me because my office was there. So, right. And there's a whole thing about the downtown Dallas business area because AT&T has left it. So there's a whole, from a local perspective, as well as the history of the city, it's a big deal. Technically, it's not the original store. The original store burned down, but this was the store that really put Neiman Marcus on the retail roadmap 100 years ago. And it was where the executive offices were, as well as the famous Zodiac dining room and all these kinds of things. That store was never really a big volume store once the North Park Mall store opened, which is only 15 minutes away. So that store became really a store mostly for long-time clients, many of whom didn't even come into the store, worked directly with salespeople, older clientele, so many of them are probably not buying anymore. And it was a little bit of a tourist store. But almost anybody who comes to Dallas that wants to shop is going to go up to the North Park Mall, which is really one of the premier high-end malls. So most of that business will transfer. So I don't think it's going to be material. In fact, it'll end up probably improving the profitability of the overall Dallas market by not having the expense of that store.
All right. Well, let's wrap up with what's on our respective radar screens. Now, it's a funny thing. It's been going on and on and on, despite the short time frame first presented to us. But what are you thinking about the state of the impact of the Iran quagmire?
Well, this is not a political or foreign relations podcast. So I guess, the thing that really strikes me the most, I guess, first from a leadership standpoint, is, and I guess it's calmed down a little bit, but who knows? As we always say with this thing, we talk about something and then, 12 hours later, some other piece of news. It's been the case, and it was actually quite nice, to not be paying much attention to TV while I was on a 2-week vacation. But of course, as most of our listeners would know, there was a stretch for several weeks where a deal was imminent.
Done. Basically done.
Yeah.
Basically done.
And I think the New York Times or somebody counted up, 8 times where we have agreed to a deal. And of course, at least as the time of this recording over the weekend, a deal does not appear to be imminent. So, I've started to call it, the art of the squeal, which is, Trump says something and, whether there is any validity to it or not, I'm going to say mostly not.
Crossing the I's and dotting the T's,
Yeah, it seems to keep blowing up. Now, I don't think the Iranians are a particularly reliable source of information either. So, right. But, obviously this has become quite problematic, and we don't know whether there is really any end in sight to this. So we shall see. But what I wanted to just mention is, in particular, over the last several days, there have been a number of very concerning reports about what's going on. One is that the overall safety net, the stockpiles, the reserves around the world could evaporate in many markets within the next few weeks. The U.S. stockpiles, now we talk about the U.S. as being largely insulated from all of this because we are a big oil-producing nation and don't import all that much. But the U.S. stockpiles are been down for 7 straight weeks. This is both an issue for the market itself. It's also a national security risk. So China, I hope you're not listening, but, Taiwan may be looking a little juicier for you since apparently we have no missiles or any oil to engage in another conflict. Though Cuba, I guess,
don't worry, Canada will sell you more. We're your number one, in case you didn't know. We are number one exporter.
But anyway, the stockpile issue is much worse in many places outside of North America. But the OECD warned of severe economic slowdown if the war persists more than another few weeks. And another report was that the oil industry execs, now they're probably about as reliable as the Iranian regime, but they warned the Trump administration that oil prices are likely to spike in the next few weeks if this is not resolved. So I think we're just getting closer and closer to the ledge here. It's turned out that in a weird way, it was a good time to have a crisis because worldwide reserves were unusually high at the time this all started. And also, of course, as prices go up, the demand goes down. So, that has extended, the period of pain that many markets can withstand. But it does sound like we are really getting closer to a real crisis. Now, this isn't a retail thing, but a little factoid here that I thought was interesting is that U.S. airlines will pay roughly $25 billion more for jet fuel in 2026 at the current rate, more than they expected. That is more, just to, okay, $25 billion, that sounds like a big number, but what does it mean? That $25 billion in 2026 is more than the entire industry made in 2024 and 2025 combined.
All right. For me, what's on my radar screen? It's California dreaming. I'm off to San Jose next week for the opening of the very first location of T&T in California, third, I believe, in the U.S. Who is T&T? The largest Asian supermarket chain in Canada. They got about 30 stores. They're at the forefront of Asian food innovation. They are amazing stores. And, we say in the grocery business that, the Chinese consumer, the Asian consumer, they rethink entirely how the business thinks about what they define as fresh. Like fresh isn't a piece of fish wrapped up in plastic. No, fresh is, it's still moving on the plate and I'm going to kill it in front of you. That's fresh. That's, that it's just so an interesting, and the new store openings have to be seen to be believed, dancing dragons, musical act. I'm going to be on a stage interviewing the CEO, broadcasting it to people waiting in line. Like these things are events. By the way, the CEO is Tina Lee, the great Tina Lee. The store is named after her and her sister, Tina and Tiffany. She's
I was wondering,
CEO.
I didn't know that.
Now they became part of the big Loblaw family, Loblaw grocer here in Canada, but they're making the moves in the U.S. So my observation of all this is, keep an eye on what grocery does. They've got the traffic. They just build excitement into what happens each and every day. The winners in the grocery store, whether it's format, excitement, that's where to watch. Now, of course, they've got e-commerce. They've all got food delivery.
Yeah.
But if you want to see where some great innovation is happening, and by the way, it's not in the retail media space. I mean, sometimes in the context of grocery, we talk retail media, boring compared to what's happening at a lot of these grocers across North America. So pay attention next time. Go to a local grocer and experience it. There's amazing things happening. and I'll report back from this great opening in San Jose. That's a wrap on this episode. We will be back next week with our analyst segment, diving deep into the issues of the day. But for now, let's leave it there.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.